Founders Floor, a co-working accelerator for startups.
I've actually had the pleasure of doing this event before, and it's a wonderful organization. We were just talking a little while ago about how it's a South Bay activity, and as much as we all know there's a lot going on in the city, but since it takes 2 hours to drive up there, I'm glad we have this. I'm glad we have Founders Floor down here for that and a whole bunch of other reasons. Anyway, fellow entrepreneur. I worked at big companies first in my career. Biggest mistake I ever made was not being an entrepreneur right away, but back in the Middle Ages when I started, you had to put your house up as collateral, and I didn't have a house, so it was hard to be an entrepreneur back then. Anyway, about 20 years ago, I got involved sort of in the entrepreneur community and started a couple of companies and ran a couple of companies, and then one of the investors that was involved in one of them, Venrock, offered me an opportunity to join as what's called an operating partner. There weren't too many of them in the Valley, but basically I manage all of our super high-tech portfolio, sort of the semiconductors and wireless and network infrastructure, back in the day when there were lots of those. So there's less and less and less of those of you who are doing hardware companies. Now it's robotics and drones and IoT, and that. So I've sort of morphed into that space. If you don't know Venrock, it's a 50-year-old VC firm that used to be the investment arm of the Rockefeller family. Now it's an independent firm where the Rockefellers invest individually. So they're just kind of a small part of it. $500 million every 3 or 4 years. We invest in 30 plus or minus companies per fund. And over half is healthcare, which is a bit unusual. As a matter of fact, it's extremely unusual in the Valley. We're one of the few that's been very successful with it. And then the other half is all tech. And a lot of enterprise software, just because that's kind of in. We do some consumer stuff. And the one thing that I've always liked about Venrock is we're just looking for good deals. So you always will talk about this, but the thing you need to know about venture capital firms and investors in general, and as much as it hurts me to say this, some of you may have heard me say this before, but I went to school for all these years to be an engineer, and I was so proud of it, and I turned into a banker. It's like, I don't even know what to say, except it's the truth. So when you're talking to investors, you have to remember they've got the banker hat on. How are you going to make money, right? That's been a hard thing for me to learn. But anyway, it's a bit about Venrock. It's been a great run for the last 10 years, and I hope I can answer some of your questions.
Well, you did your time.
I did my time.
Yeah. So I had a long career in the high-tech industry. I was mostly in the semiconductor and systems industry, so that kind of places my age. But I was at 6 startups. 5 of them I was I was an early employee. 1 of them I was a founder, and 4 of them were successful. So I was fortunate. Last startup I was at, I was a founder, and I left that company after we were acquired, and we had an earnout, and after we finished the earnout, I left that, and that was in 2014. Since most of my career was spent in startups, I also dabbled in investing in startups, and when I left my last operating role, I was thinking of doing another one, but I ended up joining a group called Sandhill Angels and became an active investor in that group. And I joined the board of directors. I'm on my 3rd year on the board. This year I'm treasurer. The group actually started in 2000, and it evolved over the years. It's quite different today than the way it was when it started. I've only seen it since 2014, and it's mostly, well, first of all, it's a very diversified group. Most of the folks that join are entrepreneurs themselves or were past entrepreneurs. And in general, we're a very entrepreneur-friendly group. It's a member-run organization. We don't charge startups to present, and startups that we invest in, we really try to help them as they progress. We do about, nowadays, we do about 40 deals a year. and deploy about $6 to $7 million. Probably half of that is in new investments and half of that is in follow-ons. It varies from year to year. This year we're on track probably to do $7 million in investments, which is, it's small potatoes compared to Venrock, but we invest at a different stage. Yeah. So perhaps one of our highest profile investments that you might have heard about recently in the news is Juul Labs, the e-cigarette company. It's a Vice company, but we were one of the first investors in 2008 when it was valued at maybe $2 million, and now it's a $16-17 billion company. So we've had other successful exits, although maybe not as high profile. And Juul is not quite an exit yet, but they'll probably go public sometime soon.
So I'll start off asking the first question, okay? But I want to let you know, though, that if you want to ask your question, you can. So you can actually introduce yourself to the investor panel, talk about your company quickly, and then ask your question, too, okay? So I'm going to ask the first one, but, a lot of companies tonight, they're fundraising. And so, and they might be fundraising for the first time. How much time does it normally take to start up, from start to finish, from the time that they decide to start pitching to money's wired in the bank? How many months does it typically take, you think, to get their head wrapped around it,
Well, that's obviously an important and a great question, but I'm trying to figure out the best way to answer. I think that the right thing to say is you need to know who to pitch to. I think the biggest mistake, and it happens every day in my world, entrepreneurs go to the wrong investors. Like, for example, if you're I'll answer whatever questions you have, and I'll stay afterwards and talk to as many of you as I can. But for Venrock, for example, is a Series A, Series B investor. And minimum check size might be a few $1 million. But that's not the important thing. The important thing is we invest in companies that are at this Series A bar, which changes all the time. It kind of goes up and down depending on the economy, how comfortable VCs are with how much money there is when this fund is finished to raise another fund. So right now things are pretty good, but the bar for Series A, as I describe it, is you've got a team, you've got a market, a large market. It has to be $1 billion plus market, and that's not just a magic number. We can talk about that later if anyone wants to know why is $1 billion so magical. I'll tell you why. And then it has to be $1 billion market. You have to have some product, prototype or something that you've shown to someone in your market, and you've gotten a response back that it's something they would buy. And if you do that for 5, or depending on the market, if it's an enterprise market, you only need a couple of customers to say something. If you're a small, medium business, you might need 20. And if you're consumer, most VCs won't even invest until you have metrics on your uptake, because no one trusts what consumers say. You could give me a survey and say, Steve, do you like this water bottle? And I say, I love it. And then you say, that'll be $1, and I'll say, no, thank you. Consumers are the worst. We're all consumers. And so VCs, for the most part, don't invest in consumer deals until you've proven that people will pay for the service. So depending on the market you're in, the kind of validation you need determines things. And then I'll answer the question. I'm sorry it takes so long, but it's important. And then I would say it's a bimodal distribution. In other words, there are companies who have everything set up. One of the guys in the front row, you have a company, and you've got your pitch deck, you've got your executive summary, you've got your financial, your pro forma financials, you have your list of referenceable customers. You're all set to go. If it's a check mark and all the good market, good team, good whatever, you'll get funded in a couple of months or less. If you don't have all of those things ready, people will never say no, because they don't want to lose you. God forbid you invent the next Google. They don't want to miss it. So they'll say, let's just stay in touch, right? Which is the kiss of death for you. If they say that, just run the other way. So what you're either in that first bucket where you're all ready to go and you'll find the right investor, or it's just going to take months and months and months and months or never happen.
The friend zone.
The what?
The friend zone.
Yeah. And the final comment about investors: find the investors that match the size of your deal, that have invested in the past in the sector that you're in, right? If you're an investor, use the house analogy. You're probably not best served if you just moved to San Jose and God forbid you have enough money, but you wanted to buy a house. You're not going to buy the first house. You're going to look all through the neighborhood. You're going to look at all the neighborhoods. So when you come to an investor that's likely to invest in you, they know your market already. If you talk to an investor that doesn't know your market, they're probably not going to invest. It's too risky. So you need to find the people who know what you do, and that'll get you halfway there. Most entrepreneurs don't do that. Anyway, I'm sure Amos has some comments.
Well, the ideal period, I think, is keep it as short as you can, because you're trying to build a business and you want to get back to work. But I mean, I agree with almost everything that Steve said, that you need to be prepared, you need to know who to go to. Yeah, I mean, you have to have your act together. So yeah, but I don't think there's not like one formula for everybody. Those startups that are really well prepared and have it right will raise money quickly. I've seen startups take anywhere from, just a couple months to 8 months to raise money. The worst scenario is if you do drip financing at the seed stage, where you're constantly raising money over a long period and you don't really have time to work on your product and on building your company. So.
Okay, so my question was, what are some of the issues with founders that keep you from investing in them and or their projects?
Well, that's a tough question to answer. When you have an investor-founder meeting, there's two people there. There's got to be some chemistry. Every investor has their own things they're looking for. Obviously, you're looking for a passionate founder. I mean, I look for passion. I look for articulate. Somebody that can express their vision properly, that has domain expertise is a big plus. The kind of founders I stay away from are those that become argumentative and defensive. You never want to be defensive when you're pitching to an investor. If you don't have the answer, or if you can say, I respectfully disagree, and provide arguments that. Or provide what you think might be supporting arguments for what you're thinking about. Yeah, I think those are the things that come to mind. I'm sure there are others, but
yeah, I would say this: it's not so much the entrepreneur; it's the team. So sometimes, and there's two things I would say. One is this, where somehow the team has to be matched to the market. Even if the CEO or somebody else came from a different industry, the team has to feel like a good fit. So I think in a large percentage of deals where it's quote unquote founder related issues, is that the founding team is not well matched to the market, which in one sense means they don't have the right experience, or they don't have the same insight. Now for consumer deals, you could argue we're all consumers, so that probably doesn't apply as much as enterprise deals or service provider deals or healthcare deals, where we're really looking for people that know things. The other bit of advice I'll give you, and it's one of my favorite pieces of advice, just relates to all of us have relationships in life, either with our significant other or whatever. You build friendships up in college. You get to build relationships by meeting someone or dating someone or whatever every day, week after week after week, month after month after month. You talk on the phone, you meet for dinner, you go to the movies, you do whatever, you go out with your friends. And you do this for a long period of time. I mean, some of us were married, you know, maybe we got married in a few months, or, you know, or some of us date for a few years or whatever, but it's a lot of meetings. I'm talking hundreds of meetings, right? I mean, pretty unusual for you to have a best friend or a significant other that you didn't go out with 100 times before you sort of acknowledged, oh, this is one of my best friends, or it's my significant other. Put yourself in an investor point of view. We're getting married for 10 years. It's to you. And so we're going to be together until you have an IPO. I mean, we're thinking positive here. You're going to build $1 billion company, and we're going to be together all these years. How many times do we get to see you before we write a check? 5, 6, 7 times? That's it. That's it. So just think of that situation, that you'd have to make that kind of a decision, right? Both sides, with just that shorter number of meetings. So the advice for you, and it really isn't advice on what to do, but it's advice on what not to do. And that is, it's unfortunate, but we're looking for red flags. And what falls out at the bottom are the people that didn't have any red flags on that component. I mean, we're looking at the market, we're looking at your product, we're looking at all these things, but in the bucket of things that says founder issues and can we work with this person or these people, anything you say that's sort of off the reservation or isn't quite right, you're almost thrown out. And I don't mean it to sound harsh, because it's not this hard to do. You just have to know it. So if you answer a question that you didn't know the answer to and you answered wrong, geez, this person guesses. Ooh, I don't think I want to invest in someone who guesses. Or if you don't disclose something, which maybe happens in 0.5%, but the person sitting next to you is your husband or wife or cousin, and you don't disclose it, you're done. So all of that's a minor one. This is kind of an interesting one, because it happens, I don't know, to me at Venrock in 10 years, probably half a dozen times. That's small out of thousands, but it's interesting. But everything you do in these investor meetings, you don't want to be nervous. You want to be yourself, but you just have to remember, you need to be straight. If you don't know the answer, you don't know, you'll look it up. Or if you had a failure in the past, you don't have to be defensive, but you can explain what happened. It's just tell the truth, be yourself, and recognize that you're kind of on stage, but for a good reason, because we're only seeing you for a short period of time.
Now, just to add to that, be really transparent and don't bullshit. Investors can really tell when you're giving a bullshit answer, and that's the biggest turnoff. They don't want to hear that. But tell the truth. I mean, because if you don't, investors will find out, and that'll be a major red flag. So.
To reinforce this, I mean, the reality is, especially when you're early stage, pre-seed, seed, there's very little data points you have to make a decision, okay? And so really what they're looking for is in those limited amount of meetings that you have with those founders is what they can see and hear at that point. It's only when you get to the Series A and beyond are there real hard metrics that you're almost trumping and dictating what that investment is going to potentially happen or not. And so, gray area, founders love, pushing the gray area a little bit on what their products can do now versus in the future, but you got to really be honest, and they're looking for those things where they're slightly lying. It's always a no, always, because it's just going to be more of the same. So, Barack Ali, I have a question here if you want to ask it. If you don't, I'll ask it for you. Okay. The question is, how do investors find the areas of interest? How do founders find the areas of interest for investors and what they like to invest in, and the limits of what they invest in regards to stage and stuff? So, this is on the website, but sometimes interests of what they invest in is sometimes hard to find sometimes. Can you shed a little light on the stages and the areas of interest that investors have, and where to find that information at?
Okay, well, the obvious thing is from folks like us, we post our profiles on the website, so you get it, right? The second thing I would say, and this is, I think most of you know this, but I can't emphasize this enough. We get so many inbound requests, not telephone calls anymore, mostly emails, but we have pitch nights and all kinds of things. Highly, highly likely, high 90 percentiles, the companies that we're going to fund are either prior CEOs that we know or introductions from trusted partners. Now, who are trusted partners? Procopio. If Roger sends me a deal, I'm going to look at it. Silicon Valley Bank, Wells Fargo Bank,
Founders
Deloitte.
Floor.
What?
Founders Floor.
I'm sorry. Gotta give the host, his
I'm just
Founders
kidding.
Floor. Absolutely. Yeah, I flunked. I'm done. He'll never invite me back. So, but anyway, you get the gist of it. The great thing about being in Silicon Valley, which is one of to pay the high, to live with the traffic and pay the high housing prices and living costs, what you get is every other next door neighbor is in the industry. You have contacts. So it's all about getting contacts, and people say, well, how do I get those? Open up a bank account, get one of the auditor firms to sign you up, get one of the attorney firms to, connect with you. There's probably half a dozen different sort of ecosystems, partners that you can get a hold of. They know us because we all circle, and they say, can I send deals to you, Steve? And I say, sure, and we can build a relationship. They kind of know me, they know what I'll do. That's the way you get into, at least at the VC level. It might be different at some of the other levels, I'm sure. Alice, comments?
Well, we post all our portfolio companies on our website. But the best way to describe our group is we're generalists because we have like 110 members and there's a large variety of interests in the membership. So you get the full spectrum of companies and sectors that we invest in. In terms of finding out, which VCs to go to, just take some homework, whether through, if you're targeting specific VCs, go to their websites, look at what they've invested in, find out how much they like to invest. It's usually on their website. They describe what they do, and just have to do your research. In addition, there's just a ton of resources nowadays out here. There's a ton of accelerators. They all have information on their websites. Yeah, there's Founders Floor. There's YC. There's if any. And if I don't know, there's a great podcast that I love to listen to. It's Jason Calacanis, This Week in Startups. It's a great place for information. Yeah, so.
Part of it is the filtration process as well. Investors put this on their sites because they're looking to find the individuals that actually have read that, did their homework, if you will, before they approach them. It's the ones that just mass blast the emails and stuff that you don't even open the emails, and they wonder why you don't get followed up on it. So it's just one of those where we're looking for tells, we're looking for things on, have they done their homework, have they found a way to be able to get a hold of you even though they don't necessarily have your direct email, but they went to an event just like this to be able to shake hands with Steve so they could do a follow-up afterwards. Those are the hungry things, or characteristics you want to look for in those founding teams you want to potentially invest in. So.
Yeah, one more comment. Like for angels, you'll typically find which companies they've invested in on their LinkedIn profile. A lot of angels put it there. A lot of angels put it up on their angel list profile. I have all my companies that I've invested in on my angel list profile, and it's about 100 companies over the last 6 years. So.
Last question for tonight, and then we're going to get the pitch event started. Hope, would you like to ask your question? Hope? Hope? No? All right, I'll ask it for you if you'd like. Okay. The question she had was, how hard is it to get funding on an incredible idea when the founders only have a proof of concept? So I assume that means not an MVP type level. How hard?
Yeah, so I think in this, okay, so maybe this is a good time to throw this in. It's good. So we talked about stages of investors. So on the far side, right side or left side, you got friends and family. And I always say, the reason those people give you money is because they love you. Your mother, your father, your grandfather, your college friends, your whoever, that are it's the it's not meant to be an insult, but it's the dumb money. They didn't do any diligence on you. They love you. Here's a check. A lot of people raise money that way, and that's how people get started, okay? Then you work your way up to angels and seed funds and then VCs, and what sits above VCs is like growth equity, where they write the $50 and $100 million checks of companies that they only look at the numbers. They don't look at the entrepreneurs. They just look at, are they making money? And then there's the private equity guys on the high side. They just do buyouts. They buy the whole company. And then somewhere in the middle is corporate investors that don't make, all those people after friends and family. Why do they make investments? Because they want the return, right? They want more money than they gave you back at some point. And then the final reason is the corporates that may not do it for monetary reasons, they may do it for strategic reasons. They're investing in you to learn more about what you're doing to help their own business. So if Bosch invests in you, or Merck invests in a healthcare company, or whatever, strategics, Google invests, they're generally not doing it for a return. They make money selling their own products. So it's either love, money, or strategic reasons, right? So the question about, well, how do I'm real early stage, right? You're likely gonna have to get money from someone who loves you, right? Unless you can make such an incredible case that you've got something so unique or differentiated or whatever, that if you got money from an angel investor to get to sort of the next round, that there's a real possibility that it's gonna go. But you just have to put yourself, if you were spending your money and you were gonna give your money to an entrepreneur, how confident are you that you're gonna see it again, right? And when the companies are real early, for financially driven investors, that's the challenge. That's why I said early on that getting validation from the market is probably the single best thing you can do. Is that?
Yep, absolutely.
Yeah, so if you're a first-time founder, you're better off doing the friends and family thing before you approach angel investors or seed stage investors. It's really hard to raise money just with a proof of concept. If you've already had a successful exit and returned money to investors, it's usually a lot easier, even if it's a proof of concept stage. So yeah.